All right, guys, let's continue with what we need to today. We are going to be talking about, as we said, on the risk aspect of fraud and risk, and let's look at this. The different types of risks that organizations, particularly banks, need to be careful about. Now, so the objectives, obviously, on the risk side of it, as we said today, we are going to introduce you to the different types of risks that exist, especially in financial services. Now, the risk function has also grown over the years. As I said earlier, the risk function was reporting into the CFO or the Chief Financial Officer, who used to double hat both the finance as well as the risk function. Over the years, the central bank, particularly in the banking services, wants the risk function to be reporting separately or independently to the not even the CEO, but to the board of directors with a dotted line reporting to the CEO. So as a result of which, the finance function has delineated with the risk function to be able to provide an objective and an unbiased view about the risk that the organization is mitigating on a regular basis. If you are heading or looking after the corporate strategy function, that's where risk is also becoming very important for the strategy officer or the manager, because the risk aspects need to be considered when developing the corporate strategy. So a lot of your strategy initiatives have got to be vetted by risk, and that's where the duo work together to make sure that whatever plans that you've made are risk-free and are conducive to the organization. So the function of risk, besides scenario planning, or besides a risk register, or besides making sure that the risk is something that the organization has worked on, it has become extremely essential to know whether your strategy has been risk proof or not. And if not, then obviously that is a bad strategy to work with. So that's something that is there in the market, that is there in the industry. And in the past, the risk function would man about 2 or 3 people. Today, the risk function mans about 7 to 8. If the larger the bank or the organization, they man about 10 people as well. And that's the number of people that are required for risks. And we'll see what are these people looking after in terms of risks that they need to consider within the organization. Now, for a bank, right? Now, an asset for us is actually a liability for the bank and vice versa. So, for example, if we have bought a fixed deposit or opened a savings account or a current account, as it is popularly called as CASA, then that is an asset for a consumer, but that is a liability for the bank for the simple reason that this liability needs to be paid back to the consumer or the customer at a time when the customer wants to close the account, break the fixed deposit, or even mature and pay it back to the customer, or an overdraft facility. And and all of these associated with the account. So current account, savings account, fixed deposit, recurring accounts, all of this are a liability product for the bank, and there's a separate team of people who manages the growth of this particular function within the organization. The asset products on the other side are your liability products. So if you've taken a home loan, obviously a home loan has become a little bit more expensive now thanks to the Fed rates. Credit cards, personal loans, all of these provide income to the bank. The interest income that they get or the fees income that they get are all providing income to the bank, and hence they are asset products for which they are for which, I mean, for us they are basically liability products. So from the bank's point of view, an asset product is everything to do with cards and loans, and there's a separate team looking after loans and cards, and there's a separate team looking after liability products, which is basically your current account, savings account, etc. The different kinds of risks faced by organizations, four broad kinds of risks that are faced. First one is, let's talk about the credit risk. The second one is a fraud risk, the operation risk in the market risk. So let's talk about credit risk. What is your opinion, people, about credit risk? Credit risk? Anybody?
When a financial institution is not able to pay our claim, that is a credit risk.
When the
like LIC, when policy matures, that time they are not able to pay to the consumer, then it is a credit risk.
Then that is basically a reputation risk as well. So, okay. Anybody else?
Similarly, it is for bonds also.
Sorry?
Similarly, for bonds also, when bonds get maturity.
But you're saying institution not paying, yeah? What if the
institution not paying?
Yeah. What if the customer is not paying? Then what would that, where would you classify that?
That is also credit risk only. Even customer is not paying.
Mm-hmm. Okay.
Loan default.
Mm-hmm. Credit card non-payments.
Yes.
Yeah. So credit risk leads to credit loss, and the credit loss becomes a loss when the customer is not paid back its dues to the bank. It could be a loan default, 1 month, 1 year, whatever that is, credit card default. It also leads to inactive account, which has no minimum balances, and therefore there are interest charged on or fees charged on that, and that still does not get uplifted. Your still minimum balances are on. So all of this leads to loss to the bank, and that is a credit risk to the bank. The reputation side is treated differently. Now, if the bank goes bankrupt or reputed, then it is out of all of this. Then it has to install its business activities and look at other avenues of raising funds to pay to its creditors and debtors and other stakeholders. Okay. So for our discussion, credit loss is loss that is incurred by the bank because of credit risk, which arises because of non-payment of either a committed installment or a non-payment of even the minimum financial credit card payment on the due date. Okay. Fraud risk. I think everybody knows this. What are the fraud risks that we talk about? Yes, fraud risk, please. Session 1.
Using some
money laundering.
Okay. No, that's just one, guys. Yeah. Okay. So can you say the full thing, please? Money laundering inside app. Okay. Anybody
using
else?
other credentials, doing some transactions comes under the.
So now you're a fraud expert. So the right words, please. Phishing. Identity theft. Yeah, these were the 4 broad ones that we spoke about that leads to a fraud risk. So if a fraud transaction occurs because of these 4 areas, which is either insider threat, data compromise, or you phishing, or it is money laundering, all of these account for fraud risk. And what happens when there is a fraud? If you can recover, wonderful, but if you can't, then it has to be written off. Of course, the financial institutions have insurance against it, so they get part of it which is insured. But if they don't, then that goes straight as a write-off. Similarly, there's a credit loss that goes straight as a write-off. Yeah. In the case of the fraud risk, the victim is usually, or the sufferer is usually the customer. In terms of the credit risk, the sufferer is usually the institution or the bank. Okay. Operational risk occurs because of the operations of the organization, which is the IT systems going bad, or human resources going wrong, or people not doing their jobs right, etc. And all of this leads to operational risk. So if you have a consultant coming into the IT domain and they have all access to the servers, that raises an operational risk.
What about when you want to make money, transfer money, that time servers are not available? That also comes under operational risk?
No, who are you? You're a customer?
Customer.
Okay, you're a customer and you want to transfer money, and the servers are not available because of whatever reasons. So if it's a half an hour delay, that's okay. That's not an operational risk. Why are they not available? Because of maintenance, and usually banks do this maintenance where there's minimum disruption happening. So right in the middle of the night or stuff. So if it's a regular part, then it's okay. But if it's not a regular part and it's a disruption that has happened, then obviously it poses the risk, and that can be classified as operational risk.
Okay.
Okay. Market risks. Market risk occurs because of market fluctuations. Fed raising interest rates for the 10th time in whatever 2 years' time is the market risk that has been posed to the loan portfolio of banks. Yeah. COVID, the geopolitical tensions globally, all of these are market risks. So if we have done strategic market management together, and in that we have PESTEL. So market risks occur because of macro environment analysis, in the sense PESTEL analysis. And that poses a risk which the organizations need to be considered. So interestingly, guys, the fraud and risk manager will also do a PESTEL analysis. The strategy manager will do a PESTEL analysis. The HR manager will do a PESTEL analysis, therefore done by different functions to serve different needs of the organization. The market risk will do PESTEL to understand what are the risks and how you want to mitigate them. Yeah, that's why I said, Vishwa, if it is a regular regulatory, then it's not an operation risk. But if it is a sudden, stop of the servers and they have not been working for a time, then obviously it poses a risk because it's an unplanned event. Yeah, so credit risk, market risk, operational risk, and definitely fraud risk. Of the four risks, guys, in the past, the risk manager was one person and had two people reporting into him or her. One looked after credit risk, and the others looked after all the other three risks. Today, you have four different people, or probably more, depending on the size of the business. So you have, for example, in the banking level, you have two people in credit risk, one for retail and the other one for corporate and SME banking. They look at their risks. Fraud risk is another person looking after fraud risk because they have increased quite a lot in terms of volumes and size. Operational risk is a third person who used to look, it gradually expanded to fraud risk, credit risk, and other risks. Today, credit risk, fraud risk, operational risk, and market risk. And there are these four distinct people looking after these risks for the bank because of the sheer volume of these risks that have occurred in the market. And post-COVID, the market risks 2020 onwards has also increased a lot. And now there is a different person looking after this risk as well. Now, for the credit risk, yeah, you have the risk guy in the risk function, and they work very closely with the credit team. And somebody has to allocate a person in the credit team who's going to report the numbers desired to the risk team as well. The operational risk has a friend in the operations, with the chief operations officer looking after IT and operations to be able to support them with the operational risk that they want to classify. So yes, the operational risk is a function of the operations team, in a sense, providing the inputs, and on the risk side, reporting into the operational risk person, ultimately to the chief risk officer. So these are the four kinds of risks that are classified by the risk head as the financial institutions are concerned. So credit, we've talked about this. Any questions, anybody, on any of these? Is this clear? Okay. So through this, do you now see a link between fraud and risk? Yes, and all of these are going to feed into fraud also, but the fraud risk in particular directly feeds into the fraud function of the organization. So they have to the risk. So the fraud part is also in a sense, residing with the risk head and also the audit head. So credit risk is obviously because of the credit given to the customer, and the customer has defaulted on that, and that leads to a credit risk. Now, this is an important uh, challenge that organization and banks also have to pay, which is balancing between risk and rewards, or balancing between risk and business. More the appetite of the banks, more risk is what they take, and more profits is what they get. Less the appetite of risk for the bank, less money they make, but there is less risk also involved here. But banks need to come up with the right balance, because you have to make money. You do have to give unsecured products as well to the customers, unsecured products based on unsecured, collaterals. And that is what is making this function even more challenging, because while you push for sales, please make sure that the kind of customers that you're onboarding are not prone to risk, because right from the beginning, your portfolio will be looking after risk-based customers and not risk-free customers. That's something which is not a good strategy for the bank. So we'll come to this case study in a minute, but before that, let's try and understand, okay, this is also another, big one in the world of fraud and risk in India. And there are two branches that have got significantly impacted. The Mumbai branch, they had a problem with regards to bill discounting fraud amounting to 350 crores from their Ahmedabad operations. And this is the Delhi branch, and this is clearly because of illegal transfers and therefore money laundering worth about 6,000 plus crores in foreign exchange made to Hong Kong. Okay, so two huge amounts of scams happening here in terms of frauds. We know what is money laundering. Let's try and understand what is bill discounting for a bank and how does that bill discounting function work. So bill discounting is obviously it is a corporate banking function and not a retail banking function, wherein the seller obviously sells goods to the buyer and in return sends a bill or saying that this is what I've sold to you. The buyer in return needs to accept the bill. The seller in that case will present the bill to the bank, okay, who acts as a guarantor on behalf of the buyer. So the bank who acts as a guarantor is going to acknowledge the bill and pay the money to the seller and then receive the money from the buyer at a later date. Whatever 50% advance or whatever that needs to be paid gets paid or credited by the buyer. The seller then starts the selling process and delivers the goods on the due date. When the goods are delivered, the buyer, pays the bank in terms of with interest and a the services that the bank has taken. Banks make a lot of money in the process of bill discounting, also called as bank guarantee, which the bank takes on behalf of the buyer. So this is what has happened. The kinds of questions that we want to answer is, of the four types of risks that we saw: operations, fraud, market, and obviously, credit, which are the risks that are evident in this Bank of Baroda case study that we are seeing, and what could have been done to prevent these frauds? What could have been the components of a risk management system, and how can machine learning have helped in such a scenario? Now, thankfully, we've done strategic management, wherein we talked about the governance structure there, or board of governance structure briefly there. If you can use that also into answer a risk management system, it'll enhance your answer as well. But if you can't for whatever reason, then just talk about how to prepare a robust risk management system. So risks, the types of risks, how can you mitigate them? How, if you set up a risk management system, what would that be? And how can machine learning or fraud analytics help in such a scenario? Okay, so those are the 4 broad questions that we want to answer. One more time, if you haven't, you can take a picture of this chart, explains bill discounting. And this is obviously the case study. Is this clear? Cool. Now we've got about 10 people here. So if you've got about 10 people, we'll put you into 2 rooms. Yeah, so that you can contribute. And please, guys, please be in the room and just don't log in and be somewhere else. So let's give you about 20 minutes of time to discuss this, and then let's come back and discuss this as a class. Okay. You've taken a picture, right, guys?
No. Can you show it again?
Okay. Okay, this is the case study. Got it? In case you want of this. And last and final, the questions. Yeah. All right, everybody's back now. So, okay, who wants to go first of the two rooms? Let's answer the first question first, which is what are the risks that are faced by the bank here? Operations, credit, fraud, or the last and final, which was market risk?
Operations.
Is a credit risk.
Okay, so can we not just say the risk we identify from the case? On what basis are we saying what we are saying?
Because I'm saying this is as a credit risk because the buyer is not able to pay the bank when it is due, when the transaction become due.
Okay.
In this case, what happened? Bank has discounted the bill and paid to the seller. In turn, they had received the money from the buyer, but the buyer is not paying. So because of this, I am concluding that it's a credit risk.
Okay.
We also thought it was the operational risk because the mechanism to send alerts for fraudulent transactions were potentially bypassed or suppressed between those 12 days when the actual fraudulent transactions happened. So it must have been something to do with their internal systems not working well or on purpose made to not work well. So it could be operational risk.
Okay. Anyone else? Okay. There's a word used here in the case which says bill discounting fraud. Here it says illegal transfers. So after this, do you still believe fraud risk does not exist?
It will exist.
Sorry?
It will exist, yeah. Fraud
It
risk.
will, because look at that. 350 crores in 184 transactions. It's not one or two. Money laundering scam, which is already said it's money laundering, and that's 6,200 crores. So the first and foremost, what is evident will be fraud risk. Now, as experts of fraud, what kind of risk? Of course, if it says money laundering, one of them is money laundering. But do you think there is an insider threat here also?
Yeah, because there is this is the new office, right? So could be a chance like means the internal employees lead to some kind of issues.
It has to be insider threat because otherwise, how did 184 transactions go through? How did money laundering reach to this kind of an amount?
Yeah. And then the internal governance in terms of somebody auditing.
Just a minute. Yeah, we'll come to that in a second. Just hold on, Rohit. So on money laundering, is it sourcing, placement, or integration? Or is it all three? First, sorry, yes, because look at that. It says in foreign exchange. So there has been a change in currency denomination.
Yes.
Wire transfer is there.
Yes, wire transfer is also there. Newly opened accounts. So there could be your integration bogus accounts. The bank was alerted to the scam when it found that the foreign exchange business of its branch shot up. So there was a red alert which was ignored. Okay, so all sourcing, integration, placement are evident in the money laundering case. Yeah. And in the other one, obviously, so all these fraud risks are evident. Now, yes, Rohit, go ahead with your point now. So that risk is established, which is fraud risk, very, very clear. And if you were to prioritize or put them in descending order, the number one risk is your fraud risk. Okay. Number two. Yes, Rohit, go ahead. You still want to say it?
Operational risk because the systems which were sending the alerts
right.
may have been blocked or
Were
on
were
purpose.
they sending the alerts?
I talked about it did not uh, trigger
No,
Send.
any.
I think no. The reports are not getting generated actually in that particular
It did
Correct.
report.
not trigger any alerts such as
Correct.
generation. So it may have been blocked on purpose by internal people. And then also there has to be internal governance or internal audit mechanism outside of the people, core people who are uh, sort of supporting these transactions.
Right.
So that may not have been very strong in terms of somebody auditing on a daily basis.
Correct. And when they audited, what came out from that audit? They said did not trigger, yeah, exceptional transaction report. So this is an operational flaw. And this clearly exhibits a maker checker system problem. This exhibits an operational flaw within the IT as well as within the branch transaction systems that are being reported. And why maker checker system is a flaw? Because there was a red alert, nobody picked it up. Also, there was no exception reports being printed, and everybody was business as usual. So a major flaw in the operations of the money laundering catch is evident here. Now on the bill discounting side, obviously these irregularities and nothing else but the irregularities because of operations. Nobody did the checks. Probably the accounts that were opened on the bill discounting side were bogus companies, and it was fictitious orders that were being placed.
Most of the bogus account.
Correct. And that is again fraud plus operations problems, operation losses. So here, guys, it is a classic case and point of fraud and operations risk, which has led to a credit loss. And there is no market risk, obviously, here. Okay. So if I were to put, I would say these two risks, which is which is fraud number one and operations number two, which has led to a credit loss, whether the customer genuinely did not pay. Okay. Any other points, questions, queries on the first part of the question, which is this? Now, to answer the second part of the question, which is what could be done to prevent these frauds? The second and the third one can be answered jointly. Yeah.
Means we can do some kind of capping during the transactions, or we can means make some kind of verification, two-way verification, like authentication, like through OTP, or maybe some telephonic conversation, through telephonic conversation kind of verification we can do here if the transaction amount is high.
Yeah. So firstly, your maker checker system also needs to be updated. So you get these exception reports, and these reports are viewed, signed off by the respective accountable people within the bank.
Even we can check, like, yeah, the same thing.
Yes.
Means the analytic system is working fine or not according to the market standards.
Right. And to be able to make this working, you need to institutionalize a risk management committee or a risk management system.
Right.
Okay. And this risk management committee or system can be comprising of your board of directors. If you believe that the CEO's role can be unbiased, then include him. But in many cases, the CEO is not even a part of the risk committee. The secretary is usually the chief risk officer, and the audit person sits as a observer in the meeting. Okay, so that committee has to meet every quarter to be able to review these kind of cases. Exception reports, KYCs have got to be in place. Any credit loss numbers that have arisen needs to be looked into. So data-driven decision making needs to be done by the risk management committee. what were the red alerts that this bank has ignored? Or what were the, indicators, if I can say, that this bank has ignored?
Limitation of the transaction.
Limitation? What
No,
limitation?
amount of transactions.
Amount of
Amount of transactions has been huge.
That
It's
they
almost
ignored
500
actually. They
times
ignored.
more.
Yeah. So both value and volume, both,
Yes.
right? And lot of accounts have been opened in a short period of time.
The outlier on the account number of
Correct.
accounts.
Correct. So in your rules, you can say if in a month's time, if you've opened, or within 2 weeks' time, whatever the time period you want to take, in a month is usually what we usually say. In a month's time, if you've opened more than 100 accounts per team member, or more than 75 accounts per team member, per team that is, then that has to be flagged. If your cash deposits are usually more than 10% of the total deposits, then that needs to be flagged into
Sorry,
the
come again,
account.
sir?
If normally what we say is, if your deposit in your account of cash deposits are more than 10% of the total deposits that have come in, then that has to be flagged. Some banks say 20%, but usually as a prudent risk person, 10% is a good number.
So it's apply on the cash only, right?
Cash deposit, percentage of cash deposits of the total deposits that have come in.
They should not be more than 10%, 10 or 20, whatever.
Max, yeah, 10 or 20%, not more than that. Suppose your cash deposits are 70% or 60% of the total deposit, it is definitely a problem. Outward remittances can also be limitized, and say if it is more than 20 or 30 outward remittance per quarter, and you can't be remit. If it's a business account, then per month, and then you flag them off.
So it depends upon the means nature of the business as well, right?
Correct. Yes. Now, so if it's a corporate foreign trading, then you get approvals before. But if it's not a corporate foreign trading, you have to get approvals from the bank as you are remitting foreign exchange. And there the approvals would have been, sorry for the word, but they have been lapsed or screwed up. Okay.
Okay, sir.
So therefore, a maker checker system is all the more necessary here, and the risk management system is all the more necessary here. So I think that answers are 2 and 3 together. What could have been done prevented? All these indicators should obviously have been prevented. How can machine learning or how can analytics help in such a scenario?
So as we have a huge amount of data, like we can follow 5 V's here. Like the data volume is here, data velocity is here. So means by analyzing means we can analyze such things through this machine learning activity.
So machine learning, it will be easy to identify patterns in the data.
Okay.
So it will help.
So, somebody said about 4 V's or whatever. Can we say this is a classic case, and though fraud analytics, but this is big data analytics with regards to because it is such a big bank, pan India, it demonstrates the 4 V's of your data analytics, which is volume, velocity, veracity, and variety. And therefore, analytics should definitely help. Because of the volume of transactions being so huge, a combination of rule-based and machine learning should both do it here to detect and prevent frauds. Machine learning will definitely help because of these 4 V's that we just spoke about. But if you can't invest, then you prioritize the process that you want to machine learn, that goes through the machine learning process. For example, reviewing of credit, or for example, transactions made, or transaction amounts or transaction frauds. So prioritize areas which are contributing most to the process in terms of an anomaly, and those processes that are definitely that need to be tightened as part of your maker checker system. Prioritize. If it can be done for all, then both rule based as well as machine learning based programs need to be put in place, offline as well as online programs, to be able to detect and prevent frauds and risks.
Even so, descriptive and this descriptive, predictive, and prescriptive also can appear.
Correct. So deploy descriptive, predictive, and prescriptive analytics. Yeah. Clear, people?
Yes, sir.
Okay, good. Now, there's an interesting video by Visa that talks about how they, try and help detect frauds through credit cards, which helps banks to kind of preempt a fraud. When the merchants are faulty, the bank itself sends an alert to the customer nowadays. And this is a lot of information coming from, collaborating jointly with MasterCard and Visa. This is a video from Visa, which I want to share.
For 25 years, Visa's artificial intelligence has been getting smarter and smarter and smarter, to the point where you probably haven't had a transaction declined for suspected fraud in quite a while. But did you know? Every time you use your card, Visa's AI is learning. Every purchase you make helps Visa get even better at protecting your next transaction. Visa's AI doesn't know your name or exactly what you bought. It sees activities and patterns to learn what your typical purchase behavior looks like, so that even before you make your first purchase, we can spot suspicious activity. For every attempted purchase, Visa's AI assesses fraud risk so that the bank that issued your card can approve or deny the transaction, or send a text asking you to confirm an unusual payment. Let's take a closer look at how it works. Every Visa account has a profile of previous transaction data. Each time you buy something, the account profile is updated and compared to the spending behavior of more than 3 billion other accounts, making roughly 180 billion annual transactions. This behavior is grouped into clusters, and your account could be in hundreds or thousands of these groups. The activity in these clusters helps Visa understand whether a transaction fits a pattern or departs from the norm enough to be flagged as high risk for fraud and possibly declined by the issuer's bank. So, in 1 week, you could buy a gift for your cousin's wedding, burritos near the office, the tattoo you'll later regret, tickets to a music festival, a return ticket for your business trip to Peru, and hang gliding lessons, so you can jump off a cliff while you're there. And none will be declined. Because even though your week seems unique, there are many others out there who also use their Visa accounts to enjoy body art, business travel, and cliff jumping. The more purchases people make, the smarter Visa's AI becomes, ensuring that even your wildest week or very first purchase will make sense to Visa's AI. Or doesn't, resulting in fraud detection when you need it, and approvals when you want them. In fact, since you started watching this video, Visa's community has helped our AI analyze more than 600,000 transactions for fraud, ensuring that your hang gliding lesson gets off the ground as smoothly as your transaction approval.
Yeah. So this was a video, guys, from Visa, talking about how it works at the back end. Quite interesting. And therefore, I thought of sharing it with you guys. So let's move on to what we want to talk about with regards to our risk analytics. So, this is on marketplace fraud, and because we have not covered that in the other case, let's talk about this kind of a scenario. So I won't put you into breakout room for this. Quickly read the case, whatever the scenario is, and I want you to tell me who's the fraudster here, who's the victim, and what's the medium or channel. Okay, well, if you're ready, let me know. Who's the fraudster, who's the victim, and what's the medium and channel that was used here?
Fraudsters are the sellers who are selling the counterfeit products or
They are
sourcing. They are they are fraudsters.
okay.
Victim is
And
the customer who is buying from Amazon,
Mhm.
and the channel is like e-commerce or online channel
The platform.
platform. Yeah.
Okay. Anyone else has a different view? So I think yes, that's correct. The seller is the fraudster here. The buyer, the person who purchases the products, knowing that it is genuine, is the victim. And obviously, the e-commerce platform is the medium or the channel in this particular case. Okay, let's look at another one. This one, it is a case of money laundering, not market fraud, and therefore fraud risk. Who's the fraudster? Who's the victim? And what's the medium or channel used here? Yes, guys, if you're ready, let me know. The fraudster, the victim, and the medium and the channel.
I think fraudster is Madan Lal Jain.
Okay. Yeah. And victim is?
Victim might be government.
Himself, I
Government.
think.
No, it can't be. It can't
It
can't
should
be
be,
himself.
it should be, I
Government.
think, the end customer, maybe.
Okay. And who's the? Are you sure the? Okay, can you say the bank is the victim here?
Yes.
And see here on right on top, it says forged bills of entry. Is that the medium? So probably bill discounting.
The victim will be bank,
Okay. And medium in channel?
NAC,
Okay. Or forged bills of entry here.
Yeah, forged bills of entry and NAC is the channel.
Mm-hmm.
NAC jewelry sales channel.
Mm-hmm. So yeah, guys, right? So the businessman and his agent are both fraudsters. ICICI Bank is the victim in this case because they revealed that Madanlal Jain, the main, had earned commission for his role in the illegal transactions of foreign remittances, and this has led to a fraud risk for the bank here. So bank is the victim, and the medium of entry is the fake bills of entry or bill discounting, or you can even say remittance. Clear? Any questions, anybody, before we move on? Now, we talked about descriptive, predictive, prescriptive analytics, and there's a very nice video that is there from Bain and Company on analytics in general. This applies to fraud and risk as well. I'll just share that video with you guys as well.
How do you achieve customer intimacy at scale? It can be really difficult with hundreds of thousands or even millions of customers. How do you know what each one is thinking and feeling? And how do you transmit that information to the hundreds or thousands of frontline employees that you're expecting to deliver personal and attentive service? You certainly can and should ask for explicit feedback, right, through customer surveys, but this is necessary but not sufficient in today's world. More and more companies are asking for more and more feedback. Response rates are under pressure. It's not a given that every customer is going to respond to these surveys. And so how do you find out what's going on with those that don't respond? Advanced analytics can help by inferring customer feedback from the vast volume and growing volume of digital interactions that are happening in most businesses today. Amazon and Netflix are great examples and well-known examples of companies that do this well today, tailoring their experiences based on inferences they draw out of customer behavior. But Amazon and Netflix don't have a monopoly on this capability. Every company can develop the analytical capabilities to infer customer feedback. We break these capabilities into three categories: descriptive, predictive, and prescriptive. Descriptive analytics literally describe what happened before, during, and after a customer interaction. And companies can use this information to develop insights and potentially new ideas about how to treat situations that often create customer delight or detraction. So for example, if a flight is late, typically customers of an airline don't like that. And so if you observe what happens, you might be able to actually change just systematically the treatment of late flight arrival. Predictive analytics take this a step farther by inferring what's likely to happen based on history. For example, one telecom company found that when a customer defected, that others in that customer's calling circle, friends and family, were at elevated risk of defection also. And so their predictive model helped them flag those situations as they were happening and trigger actions based on those predictions. Prescriptive analytics take it even one more step, which is to say automatically detecting risks or opportunities and then triggering an action based on that detected situation. And so a good example of that would be, come back to Amazon or Netflix. If I'm browsing a different movie category on Netflix than I was before, maybe new recommendations need to be served up to entice me to watch a particular movie and continue being engaged with Netflix. Working together, these capabilities enable companies to understand implicit customer feedback along with explicit feedback and act on it in real time. We find that companies approaching this task find it daunting and are best served by an evolutionary crawl, walk, run approach, starting small, building up to more complicated and extensive use cases over time. So how do you get started? We'll start by asking some basic questions. Where are we on the evolutionary scale? What experiments might help move us forward? And how do we increase the speed of iteration and learning? For most companies, this will be a multi-year journey, but one well worth taking on the way towards having a customer franchise that will be the envy of the competition.
So basically, again, a similar approach is what we also spoke about yesterday in terms of, either actual, opinions or past behavior is what you need to put into practice to detect, prevent, and obviously prescribe a robust methodology to mitigate risk and frauds. Yeah. Okay, so if we continue with this thought, let's move to our next topic that we want to talk about briefly, and that is on credit loss. Now, credit loss occurs because of credit risk, true or false? Credit loss occurs because of credit risk, true or false?
True.
True. And obviously, if these losses are high, it's a problem for the bank because your profits are going to get impacted. Your reputation also is going to get impacted, and your shareholders are definitely not going to be happy with your bank. So, the key goal of risk analytics, through risk analytics function, the CROs function, and whatever consultant they deploy, their objective is to reduce credit loss or to minimize credit losses. You can't have a zero there. Cost of capital. Now, what is this cost of capital? Cost of capital is the cost that you are incurring to provide the loans to the customer. Okay, so if your losses are high, your cost of capital goes high as well. And thirdly, cost of provisioning. The amount that you are putting aside as provisioning also impacts because that amount is a reserve that cannot be used but for allocating to provisioning in the future. So as a prudent balance sheet management of risk analytics, it is absolutely important that a risk function, these are their KPIs to manage it effectively in terms of the credit loss, in terms of cost of capital, and in terms of cost of provisioning. So how is credit loss getting calculated? So just as an example, if you have 100 credit card customers and assuming they spend about 10,000 US per month, 95% of the credit cards are used by customers and they pay their bills every month. They are the good customers. The bad customers are called as revolvers. Revolvers are they pay the minimum amount, or those customers that they do not pay the amount in full. And it is the revolvers that the banks want because they can make money out of that. So, many times as a discipline, banks will call you up and say, hey, sir, madam, do you want to convert this transaction into a 12-month, 24-month easy installment at a certain percentage? And, people are duped, not duped in the sense, people are influenced by this and they do go in and increase their purchases and say, hey, what the heck? I will pay after 1 year only at an X% of an interest amount. So yes, while that is happening, and in that process, if you overdo it, you're not able to manage your finances properly. And as a result of which, you're not able to make your dues as right. And that is happening with a lot of people as well. So assuming 95% make their payment on time, it's the 5% that do not make the payment on time. And now, therefore, if you were to calculate the revenue for the bank, it is going to be assuming though the spends are 10%, 10,000 and you're using about 50% of your card limit. So your 95% are spending about 5,000 US on their cards. Your expense and income, now that you're calculating, you just can't say based on 95%, you have a 5% of customers who are not contributing to the income. So, if you're assuming a 20% interest rate on banks rates based on the credit cards, based on the payments that they make, based on the, the merchant money that they make, it would be, if you're assuming 50% of the spends for 95% customers, you're getting an income credited to about 9.5% of the total amount. Now, the 5% of customers have not given you anything, so that's a loss to the bank. You can't say 9.5%. You've got to offset it against the 5% loan that the loss that you've made, and therefore your net, it's still a net gain, not a net loss, thankfully. So, and that is about a 4.5%. Okay, so the point that we are trying to make here is when you're looking at income, it should be able to offset it against the losses. If your good customers are not able to offset the bad customers to give you a gain at the end, that is a bad portfolio of credit card or whatever product that you're managing within the bank. But if it is, then that's a prudent risk management policy or a framework that you're operating in. Okay, so two kinds of risks, operational credit risk and regulatory credit risk. Because the bank needs to make sure that your credit risks are minimized, you want to give the best customers onboarded with regards to the products and services that you're offering. Two kinds of risks, guys. Operational credit risk is analyzing credit risk at the customer grassroots level. Regulatory credit risk is analyzing them at the portfolio level. What gets reported to the central bank is the regulatory credit risk. What gets analyzed at terms of credit risk management or fraud and risk management is also at the portfolio level. Only if the portfolio is not right, then you go down or drill down to the customer level to be able to spot any anomaly at the grassroots level. But if the regulatory risk or the portfolio seems to be okay, then there's no need to drill down at the grassroots level. Okay. Now, quickly, guys, we're at that stage. Do you want a quick 5-7 minute break and then we continue?
Yes, sir.
Okay, cool. So let's give you a 7-minute break and then let's come back and continue with our discussion.
By 12.
Yeah. So let's come back in by 12 o'clock your time. All right, people, are we back?
Yes.
Yes, sir. Back.
Okay. So this is what we were talking a little bit about risks and regulatory risks. And these risks are of two kinds. One is the expected risk loss or the expected loss, and the other one is the unexpected loss. Now, expected loss is easy because you can predict, you can you can look at the transactions and you can say, hey, this portfolio seems to be a problem, and if this portfolio seems to be a problem, let's correct it, let's come up with a indicator, things of that kind. It's the unexpected losses that are becoming a bigger challenge for the bank nowadays, and these unexpected losses are mainly arising because of market risks. And therefore, the COVID, for example, it's very difficult to predict unexpected losses at that point of time. And hence, banks and organizations took the entire 3 quarters of the year to understand how are they going to grapple with this kind of pandemic that has happened around us. And today, you have enough geopolitical tensions to look at, and that's creating a lot of losses for you as you are looking to maintain a healthy risk portfolio for your client you're working with. So, this is an example of a bank that has prudently managed its balance sheet. And how is it prudently managed its balance sheet? Through a technique called as pre-provision net revenue. This pre-provision net revenue has helped you allocate for anomalies or allocate for a default of a customer at the time of booking the customer itself. So you want to predict whether there is going to be, like you predict churn, you'll predict whether this customer is going to be defaulter, and therefore do you want to make a provision for them at that moment itself. Also, another strong indicator, which is the loan to deposit ratio, was looked at to be able to make sure that the portfolio that they have is a healthy one. Now, loan to deposit ratios of the bank is very important for investors to look at. The deposits are obviously your liability products, which is your savings account, current account, and that's the denominator, and the loans is the asset products. So the loan to deposit ratio should not be 100%, which goes to show that everything that you get as deposits, you lend out as loans. It should not be over 100% because that's bad management of the bank. It should not be 60% also because you're not utilizing your funds appropriately. So your loan to deposit ratio should be somewhere around 90 to 95%, giving you enough liquidity to manage your unforeseen days in terms of the large customer taking back the deposit or breaking the deposit or even closing the account. So 3 kinds of losses, guys. Expected losses is obviously the estimates that the bank makes based on their, their expertise, based on the behavior of the customers. The unexpected losses is because of the market, movements or market dynamics, and obviously the unexpected losses also expand or extend into macroeconomic losses, and that's because of the Fed interest rates, for example, or the recession, or the pandemic also for that matter. If as long as it impacts the economy and those kinds of things get accounted for here. If the pandemic has resulted to a drop in the real estate market, and if you invest in the real estate business, then that's an economic loss that you are going to suffer in addition to the pandemic losses, which are unexpected losses. Yeah. So the formula for this is as follows. Your expected losses is your probability of default, which is PD, exposure at default, and loss of given default. And those are the 3 elements that you have. In the unexpected losses, another element that's brought in, and that is asset correlation, which is the R value. Now, if you've invested in a particular sector, customer, industry, suppose you've invested in the real estate sector, And you've also invested through your customers. Obviously, you've given loans to customers in the real estate sector, and you've given to a tourism sector. Now, post-COVID now, it's for assumption's sake, the real estate sector has picked up faster and the tourism sector has not yet picked up. And hence, the losses that you are making in the tourism sector are offset by the losses that the gains that you're making in the real estate sector. So it should offset. But if both the sectors are doing bad, then that is a bad proposition. Can't do anything about it. And that is your unexpected loss. Okay, so expected as well as unexpected losses. As again, coming back to the things, the banks will look at all risk-based or fraud-based activities at the portfolio level, regulatory portfolio, because you have to report this to the regulator, and not at the customer level. Too much of time, too much of money, too much of investments. You will only drill down if your portfolio looks unhealthy. As long as your portfolio is healthy, in the sense, good customers are able to offset the loss from the bad customers. It's a healthy portfolio. But if it's the other way around, then there's something seriously wrong with the kind of customers that you have as your customers, clientele, and a big problem as far as the kind of customers that you are onboarding. So macroeconomic impact. Now, to answer this, guys, what is the answer to this question? How, in this particular scenario or point, when you have a high affluent customer or a customer with no income and a middle class customer. Now, this is the change in the customer status while the customer has a relationship with the bank. The customer, a highly affluent customer, obviously has become affluent and highly affluent now. Then you have a customer with no income, the customer has lost his or her job, and then you have a middle class customer. So the bigger one during the relationship basically is your customer with no income. So which is the segment which is likely to be impacted by recession the most, and why?
Hello.
Yes, guys. What's
So
your
middle
view?
class customer will be highly impacted because he
Okay.
have to manage everything like EMI and other things, right? And the affluent customer, maybe he will impact it, but not so much because he have a sufficient amount of money. And customer who have no income means definitely it will impacted that as well, but because they have don't income, so means it will not impacted anymore as compared to the middle one.
Okay. Good. Anybody else has a different view? Anybody saying customer with no income gets impacted the most?
Actually, I also feel the same, sir.
What was that, Vishwadeep? What's your reaction to that? If somebody says customer with no income gets impacted the most, because you're saying middle class customer.
So I feel middle class customer will be highly impacted out of these three.
And yeah, why not a no income person?
He have no income now, so means he's least worried about the other things like EMI and other.
Okay. And
Because he don't
other?
have any, because he have don't and no income, so definitely he will not going to take any loan from the bank in any case.
What was the other view that said customer with no income? Yes, somebody said, right? Customer with no income. Who was that?
Sir, I was like customer with no income.
Okay, why would you say that? What's your view? Because?
Because they're a middle class customer, like they don't have
Now, if you have a highly affluent customer, then what's the problem? There is no problem, because a highly affluent customer will always be affluent or highly affluent, and they should be managed their portfolios or crisis better than the others. So as a bank, you don't have to worry. A customer with no income, also you don't have to worry, because with a customer with no income, you know there's no income, so you have to come up with measures to be able to collect any dues from them. It is the middle class customer that gets seriously impacted because of economic impact, and you as a bank need to make sure through their debt to service ratio, in terms of are they more in debt, and therefore you should caution yourself from selling more to such a customer. And if they are less in debt, then consider the products that are essential for them so that they can manage their lives better. So the tough part during recessionary times is to look at the middle class customer, and that would be a challenge for the banks to, because of it is going to be a tricky situation for the bank to look into. Okay. Now, in today's time, your macroeconomic environment can be estimated and measured through certain techniques. The survival analysis is one such technique. Dual time dynamics is another technique, and impact of the economic environment is obviously something that you want to look into. Now, what is survival analysis? Any idea? So suppose if a customer has become or has you classified them as a problematic or a cautious customer today, and this customer has taken a loan from the bank, and there are about 4 years still left for the customer to pay the loan. So therefore, this customer fits into survival analysis for you to understand, of the remaining 4 years, what percentage of that remaining time is the customer going to meet his or her commitment. We were always expecting recession to start from last quarter, and all of us and our organizations made estimates of what we can collect and what we cannot collect because of the recession. So we said, as long as we can make so much money, banks used to say that as long as we can make so much money on our loan portfolio, they gave discounts and they gave fee waivers. Auto manufacturers came and also gave discounts as part of auto loans. And, as a result of which they said, we are expecting the recession to float in by the 1st of January. And therefore, until then, we are expecting customers to avail of our products and to start paying their first installments. Survival analysis. Okay. Dual time dynamics. Any idea what this is all about? This basically is everything that the bank is trying to do otherwise as well. The only factor here is you're looking at the macroeconomic aspect in here as well, which is the economic, dynamic changes or movements, and how do they impact the bank. So, today's portfolio, what extent of this portfolio is going to be healthy in the future? You have to estimate it because you have to make provisions for it. But what extent of this portfolio is going to remain as it is or get impacted, not because of credit loss, not because of fraud, not because of operations, but because of market and therefore macroeconomic indicators. Yeah, and this becomes an estimation on the portfolio. Okay, and then lastly, your macroeconomic environment itself. There are two techniques that banks use here, called as long odds as well as the score curve. This is coming from years of experimentation, also called as years of experience and expertise. So impact on the macroeconomic environment, you must be prudent enough to assume this macroeconomic environment. And, for example, for many years, people used to do that in an unstructured or a semi-structured manner, but now they do it in a structured manner. Impact of oil pricing on the purchase. Now people are talking about a wait and watch approach for gold investments. So as your price of gold is going down now, but people are saying it's going to come back up, those banks who give money against gold have got to be, obviously, looking at this kind of a stock or situation that they've talked about, because the first quarter of the year globally, gold sales have not picked up to the extent that they need to be, and the value has also gone down. So obviously, if you've taken gold as a collateral, you need to look into it and add something else to your collateral, or do an estimate as to when would this safe haven price go back up on track. Oil prices, commodity prices, all these are impacts of environment onto the risk of the bank, and a time series data trend will help you do that. Another interesting one, McKinsey as a company also has talked about it. They also invest now or they also offer services, not just in strategy or M&As, they also offer it in terms of risk analytics, something that they've picked up as an added function because their clients want it. So we'll see what they do as part of risk analytics.
It's estimated that the world produces 2.5 exabytes of data every day. In the past 2 years, we've created more information than in the rest of human history. Businesses are rushing to use advanced analytics to more accurately assess and price their risks, mitigate unwanted risk exposures, and tailor their strategies to achieve extraordinary risk-adjusted performance. In this area, McKinsey brings our clients a distinctive value proposition. We combine our expertise in risk analytics with deep experience and understanding of the business context at hand. The results provide significant and lasting impact in business performance. For example, stress testing is an area we've had great impact. In the United States, we've helped numerous banks' forecasting approaches through the development of revenue, expense, and loss forecasting models. We're now extending this expertise to new markets where banks are facing increasing regulatory pressures to conduct more extensive stress testing. Stress testing analytics also supports the strategy behind large capital-intensive projects. We've worked with several mining and energy clients whose projects are capital-intensive and especially sensitive to commodity prices. We've built models for banks, insurance companies, and others to predict credit risks, improve loan monitoring, fraud detection, and collections. In an Asian bank, our efforts led to a 30% lower loan origination cost and a 50% reduction in both turnaround time and overall losses. McKinsey is also at the forefront of model validation and model risk management. Our recent acquisition of Risk Dynamics, a leading risk analytics firm, further bolsters our abilities in this burgeoning area. Banks, insurers, and asset management companies have long relied on statistical techniques to rate borrowers. Today, we can complement traditional analytics with new techniques, such as machine learning, to find previously unidentified patterns to help clients make more accurate predictions. At a European car insurer, 40% of all fraudulent drivers were classified within the 20% of drivers that our algorithms classified as high risk. We've helped a Latin American telecommunications provider enhance their collections process and identify the 15% of customers causing 83% of losses. Models built purely on statistical knowledge can result in a wonderful correlation that's just plain wrong. Numerous models cluster customers into risk segments based purely on statistics. The question is, how should a business approach these different segments? Our business knowledge allows us to build meaning into these segments, providing new insights into how to manage the risks of these segments more effectively. We believe that risk-advanced analytics are the next frontier in risk management, using the data revolution to better predict, monitor, and mitigate risks. Because after all, it's not the data, it's what you do with it.
So, guys, explains the risk framework very well by one of the top-notch, bodies in data analytics and strategy, and they've also now talked about risk becoming an important aspect of, as part of their value that they offer to the customer. They obviously didn't have the capabilities, so they acquired a firm, which they'll talk about it in their presentation as to how they, this has helped. The acquisition and analytics have helped them to deal with their clients better. How many of you are in the analytics world of field? I just want to ask, or how many of you want to get into this world of field? None of you are?
Definitely want to get in more.
Want to get in. Currently, what do you do, Rohit?
I'm into the automations portfolio and recently in terms of the global data management.
For what business? What kind of business?
HR operations.
So you're into people analytics.
People analytics.
Okay, so attrition and churn is very important there, right?
Yes.
Okay, cool. And you want to get into the world of analytics, people only or diversified?
Diversified. I think it's more going to be HR related only, at least to start with. But in terms of how do we bring more elements of the data in conjunction with the employee data, that's going to be my focus going forward.
Yeah. Think of broadening it to also include customer analytics with you, yeah, because HR and customer now go hand in glove. Okay, there was another one, yes. As Kumar, you said you do. What do you do?
Right now, I'm doing this sales and marketing. I'm looking after sales and marketing.
Sales and marketing. So what kind of analytics do you look at? Sales management?
Yeah, sales analytics and customer analytics also we're looking to that.
Okay, so now your sales talk does not end with saying next month looks good, right? You really need to have a very good understanding of prospects to conversion.
Yes.
Good. Now, guys, the others don't, but if you look at your job profile and if you look at the kind of roles that you do, ranging anywhere between 20% to 80% is what you will have to rely on the world of analytics. Which could be business, it could be people, it could be customer, social media, digital, fraud and risk. It could be any and all of these because they're getting into specializations with regards to how you're going to functionally contribute to business. A field that is only going to grow. Must say that you must adapt to this field because if you have analytics in your skill, you want to do that because the job roles for an analyst is the future of tomorrow. Of the 20 jobs that they've listed globally, analytics and analytics related jobs take about 6 or 7 out of those 20 jobs that they've talked about. So definitely a future, definitely in terms of what you want to do and how you want to make yourself, furthermore employable and reachable and unique for that matter. That's something that you want to consider and look at. Okay. So let's move to our another, classic, since, another classic on the Wells Fargo Bank. They talk about bad projecting in Q1, and this is something that they obviously did in 2020 when the pandemic had struck the globe. So I wanted to quickly read it and or take a picture shot of this. And for this, yes, I will put you into a breakout room. What I want you to do after this case study, take a picture if you haven't done it, is everything that we've discussed so far you want to tell me what types of risks are visible here. And if it is a fraud risk, you want to tell me the types of fraud visit here and, what went wrong and what should have been done by the bank to, avoid the losses that have been made by the bank. Yeah. So everything on today's lecture, today's class, basically a great summary of what all we've talked about today. Clear? I think every time we talk of, people just reduce, people just come and say hello to yourself and they leave. That's really bad discipline. So we had 12, now it's 7. I hope you will stay. Yeah? So I am my regular loyalist, and trust me, guys, I will reflect that when I grade the the projects and the exams as well. And people who are in between grades and not a part of the class, I will obviously, for commitments, I do reward people. So let's go ahead. Okay, we again create 2 rooms, guys. Okay, so let's do that. And we'll give you about 15 minutes to discuss this, and then we'll discuss it as a class. Ajinkya, Swami, can you be in your groups, please? Because there is only Rohit in your group. And if you're not in your group, tell me, I'll move him out. Swami, you need to be in your room. Good. Sudeep, can you join your room, please? Yeah, thank you. I think the first group is here. Okay, come. Great. So now that both groups are here, who wants to go first and tell me what are the kinds of risks that are visible here?
This is Rohit speaking. Sorry. Kirti and Ajinkya also were in my team. The first risk which we could spot is the credit risk, because many of the customers might have taken loans before the pandemic, and then while the pandemic started, lots of customers also lost their jobs or they experienced pay cuts. So that may result in the EMIs not being paid on time or the loans getting defaulted. So that becomes a credit risk from the bank perspective. The second one which we could thought of was the operational risk, because potentially you need some minimum number of people to be operating in person in bank to keep it running. And sometimes we experienced almost complete lockdowns. So at that time, those operations would have been stopped completely. And the question then is how agile those banks are in terms of quickly switching over to an online form of working. So that poses the operational risk. And then we also talked about liquidity risk, because there could have, because the whole operations got slowed down. I mean, people became very conservative in terms of spending or asking for more loans. Then that might have resulted in the banks having less cash reserves. So that was one of the other risks.
So where would you classify liquidity risk as? Credit, market, fraud, or operational?
Maybe it can go for credit as well as operational.
If you were to choose one of them, then
maybe more of a credit, because there are less reserves, and that kind of ruins the balance of the bank as well.
so you are saying credit and operational risk. Those are the two elements that you are focusing this case on.
And market risk as well.
As well, okay. Market risk as well, okay.
Because the whole demand came down. So the question then is how much time it's going to take to re-establish how it was before pandemic.
So would you say, so what are the main, when you read the case, what are the main problems that you wrote, that you think of beyond obviously classifying the risks?
Their projections have gone wrong, which means, or they may not have been in a good position to come up with accurate projections, or they may not have had good amount of data, considering pandemic was almost I mean, once in a lifetime kind of event. So
okay, hopefully that's only a once in a lifetime. Yeah, true.
So adding to Rohit's point, it's like they would not have had much data on like when this would end, or how it would become better in a scenario. So to lessen the risk, they would have taken these kind of projections, but the scenario completely changed when the pandemic got better and real estate actually rose. So that's the reason it would have gone bad.
Gone bad, okay. Okay, the other team, please, your views.
So we identified this as a market risk due to COVID, because that the case clearly says it is because of COVID, and the second risk, it is a credit risk. If I list down the first one as the market risk, second one as a credit risk.
Okay, so credit and market risk. Okay, and what are the problems in the case? Besides the risk identification that you've just done.
We are losing the customers, we're losing the market.
And the revenue loss.
And the revenue loss.
They're not able to meet the revenue, projected revenue.
Okay, revenue loss, okay. Customer loss, all of that. Anything else?
Not able to, I think, assess the risk, I think. That's what.
And Wells Fargo was again known, I think, last year sometime for some more fraudulent transactions. So while this was a classic, thing. If you're talking about risk in any forum, the Wells Fargo names comes up a lot in the last 2 or 3 years, especially this one, and that's why we wanted to talk about this here. And if you look at the title that it says is bad projecting in Q1. So what time period are we talking about here? Are we Q1 2020 or are we some other Q2 or Q3 in 2020? What is the time that we are looking at now, this particular news article?
This could be Q1 2021.
It says bad projecting in Q1 2021. So the time is when this article is published or when you're looking at it now is obviously beyond Q1. So probably Q2 2020, because it has already happened. Right? And it has caused a loss of about 6.4 billion in the quarter, and the quarter is Q1. Okay, and why has this happened, guys? It has happened because
Pandemic.
correct. That's what the case says. Vastly reducing foot traffic at businesses and in public. Yeah, so this is a classic case and point of market risk. Because of market risk, there is a credit loss. Not because of credit risk.
Credit loss. Okay.
Yeah. So therefore, the entire 6.4 billion is attributed to market risks. Why? Because they were not able to project it appropriately, and they were not able to come to terms with a pandemic and come up with preventive measures. Okay, which industry? Now, when they say commercial loans, so you're talking about obviously corporate banking, right? Not retail banking. It's the commercial loan portfolio. So probably SME and or corporate, whatever, but we'll call it as corporate. What sectors have they given loans to their clients? The clients were in which sectors?
Real estate.
Yes.
Oil and gas.
Oil and gas and demand for some buildings also says real estate. Okay, so is it expected loss or unexpected loss?
Unexpected loss.
Unexpected loss. Why? Now that asset correlation here. They were investing in oil and gas and the real estate sector, which both dropped during the pandemic. So they were not able to offset one with the other. That also added pressures to it. So your second point of contention is unexpected losses because of the R that they invested in, and that is your oil as well as the real estate market. Clear? Can anything be done about this at that point of time? The news article says bad projecting in Q1 2020. So can anything be done about it to avert it, to minimize it?
And consider the impact of this one, and then probably do the root cause analysis, lessons learned, and do a better projecting in subsequent quarters.
Correct. So all of that. So now, when they go to the board or, saying that, hey, 6.4 is because of bad projecting, will the board say, and is that a fair statement to say that you should have been more prudent, you should have done a better job? Can that be said?
Yeah.
During the pandemic, can that be said in the first quarter? Nobody knew across the globe what's happening around it. So that statement by the board cannot be said. Even if they say it, nobody knows the answer, how long the pandemic will stay. So this is something that you have to take a hit on because of the unnatural calamity around you, market risk.
Some sort of pasture analysis we can do.
Yeah, even if you do pestle, but the pestle was changing every day. So while you can do that, it is not going to do anything good because, your projections, everybody's projections went for a toss. And this is Wells Fargo, not a small bank. Okay, so now there is some more article, there is some more information available, and let's look at that some more information available. And that some more information is this, which is what the CEO says. Okay, and just read what the CEO is saying and then tell me what you now think. Now what risk? Now what risk is it? Is it credit, market, operations, or is it fraud?
Credit loss.
Credit loss. It allows for the credit loss.
And yeah, it accounts for credit loss, but that is because of credit risk, market risk, fraud risk, or
Mainly because of the market risk.
Market risk.
The credit loss.
okay. So now what time period are we talking about?
Q2. We are talking about Q2 right now.
When are we saying this? In Q2 or in Q3? The CEO statement is Q2 or Q3?
Q3.
Q3, right? So what is the total loss that the bank has made? Q1 plus Q2, 8.4 plus whatever that 6.4 was. So that's close to
14.8.
about close to 15 billion US in the first two quarters, H1 2020. Yeah, the first part of the story is because of market risk. But the second part of the story primarily is because of credit risk and market risk. Why? Because by the first quarter or the first trimester, the world knew that the pandemic is going to stay. And their understanding of the market was very bad because that gave them 8.4 billion in the second quarter. They should have really been agile and alert about it. So the first quarter is okay. You can, but the second quarter is not okay because what measures have you put in place to avert these risks? And this is what they say. They admit our view of the length and severity of the economic downturn has deteriorated, which means that the world was going westward. They were not going westward. They were going in a different direction. And therefore, their understanding of the pestle went wrong. So in the first quarter, it's market risk. In the second quarter, it's credit risk. Why did you give loans to customers who will default in payment? Because your understanding again of the commercial loans of the real estate sector and the oil and gas sector was you did not do anything about it. And therefore, when it comes to decision making and agility and talking about alertness and flexibility, this case is used quite a number of times in fraud and risk. What not to do when you are estimating fraud and risk. Clear about it, guys? Any questions?
If there was an opportunity to hedge the risk in terms of, let's say, giving loans to some sectors which are still booming,
Correct.
That could have been a better mitigation strategy.
Exactly. That would have
Like
had a
FMCG.
better, yes, that would have had a better offset of unexpected loss. The asset correlation would have gone better. And a lot of banks did that. By the first quarter, nobody knew, but the second quarter knew. People were sitting on a lot of liquidity. So they closed retail banking operations, they closed commercial operations, and they also, all this staff was focusing on investment banking. And they made a lot of money because of that. Wells Fargo did not pick that up. And definitely stop lending to those sectors. Correct. Clear? Because even if they gave a secured loan portfolio against the property values went down, and therefore they had to have something else to it. The under construction projects never got built. So they added a problem to it, right? Clear, guys? So that's so the assessment of today was basically on all risks. The last case in point was more focusing on the market risk. The other earlier ones were focusing on credit as well as market as well as fraud risk, and then it gives you an understanding of how you must deploy a prudent risk management strategy. Any question? Now, when is your project submission, guys? Next Sunday?
Yes, sir. Next Sunday, 14th May.
14. And
next
do you
Sunday.
have class on Sunday morning?
Saturday evening.
No. You do have any other class on Sunday morning?
Yes.
Yes, for the
You
next
have
Course
Saturday.
class. So you have a new course plus this submission on Sunday, is it?
Right.
Okay. All right, fine. Yeah, we have a class on next Saturday. That's correct. Okay, guys. So if are there any other questions? Else we will see you Saturday. Okay, there is a feedback form again on the session board. Kindly fill it out and then exit.
Do you have any session like a TA session for specifically for project submission?
We already covered the project in detail yesterday, and we are going to talk about it again on Saturday next year.
Okay. I'll check.
Yeah, please check that.
Yeah.
Okay. So if you've done your feedback, then we'll see. Please, guys, everybody fill it so we get a decent number of people done. Thanks, Vishwa. And we see you, all of you, on Saturday. Have a beautiful week ahead of you and enjoy your Sunday. Take care, guys. Bye-bye.